Yearn has a V3 beta that is pretty slick. I really like it. But Yearn is terrifying. That doesn't mean I don't use it. Yearn's sushi pool right now is at 53%, which is nuts. Let's see. Okay, I'm gonna switch to the community call chat so I can watch what the people say. Boo boo, hello, hello. Hello, y'all. Yeah, just to give you guys an idea, I am trying out. I'm just trying to find the most complicated urine pools so that I can look at what's happening on chain as you get into and out of them. And it turns out that's very expensive in gas. But it is illuminating for some of these more complex yield aggregators. And the funniest one I could find was Curve Mim UST vaulted. And that's pretty fun. Magic Internet Money and UST. It's hilarious that you don't really have to even know what these things are in order to ape in. Presumably, though, all of our community members are yield aggregator superstars. I'm just going to assume you all are.
Well, actually, yeah. How many of you guys, you can put in the community call discussion, have you used Yearn, use Yearn? I personally have used Yearn. But I'm curious how popular it is amongst the community.
The nice thing about using Yearn is when you use Yearn, oh yeah, games are super hot right now. Yearn is really interesting because when you use Yearn, you use every DeFi platform underneath. It's wild. Alchemix, yeah. Yearn seems to be a pretty hot fave in general. I really like it. I don't know if you've all looked at the new V3 beta. It's interesting that they made it way less colorful. Yearn V2 is it just seems very vivacious, and Yearn V3 is much more conservative looking, just in terms of look and feel. Anyways,
let's get started.
Yeah, let's do it.
Cool. Thanks, y'all, for being here. It's been a very interesting month for us at Credmark. The highs of late October kind of plateaued out, and we have been building a lot. Building a lot, hiring a lot, and I think that led to some inactivity on this server over the last week. I think that was a combination of us just being focused on building, which, to be fair, I think we can do a better job of being transparent about what we're building in this server. I think it can be hard for people to talk about unfinished things sometimes, but I think it's important to show how the sausage is made. So we'll make a more concerted effort to, I think, kind of show the work. Similarly, I took a day off to focus on some personal projects. And the reason for that is because we will be launching our platform and the MVP of our platform on December 7th. And I wanted to recharge my battery personally before embarking on that journey. I think what you can expect, one bit of feedback that I've gotten from advisors, from friendlies, from community people, and just kind of intuiting sort of the dialogue I see around Credmark is that people don't know what we do still. And I get it because what we're doing has not been done before. It is complicated. It's hard. But it is potentially like extremely crucial to like making DeFi more accessible and a healthier ecosystem. So I think leading up to the release of this MVP, we are going to be releasing a series of blog posts that will detail kind of how this platform works, how CMK is involved, and how it affects you guys, the community members. There's a lot of aspects to this platform. It has been something we've been working on and thinking about for a long time. And we're really excited to launch it, but I think we want to prime everybody so they know exactly what they're getting into once this thing goes live. Neil, do you have anything to share on that note?
Sure. Yeah, I can talk all about the platform if you want.
I mean, maybe just give like a high level overview of sort of like the various topics that we'll be covering in the next few weeks to get people ready for this launch.
Sure. I think the first one and the one that people are most, going to be the most excited about is some staking mechanisms. So we have created a staking mechanism that works similarly to X Sushi, like Sushi Bar. And how that's going to work is we have a rewards pool that will essentially give kind of fixed rewards into that pool. So you can go get staked CMK, and then the staked CMK has just some of the community treasury slowly trickling into it as rewards for staking your CMK. So that's like the easiest mechanism, but we're also looking at how different ways that we can do profit sharing with the community of staked CMK holders. And the way that we're going to do that is that in order to get access to our dashboards and data, we're going to let anyone in who has staked CMK, and then for anyone who's getting API access, essentially we are going to use any profits from grabbing API access keys and holding them for a long time. Any profits that we get from that, we are going to be putting back into staked CMK, as well as some of it back to the treasury, and the split on that will be decided by governance. So for the sort of initial MVP of staking, it's just going to be an interest rate from the community treasury. And then as we move on to having more complex roles in our platform, which are going to include validators who are going to validate models and do governance work, and modelers who are going to build the models, and people who are consuming them via API. When we've got that balance totally figured out, then hopefully everybody can benefit as we increase the value of our platform in general. So yeah, the first piece of that is staking, and we're going to have it very soon. So thank you to everyone who is participating in the Alchemist Crucible. That is our liquidity mining. And so this will be single-sided staking. So it will be much, it'll be like it has a different use case, and that is to simply reward the community members instead of the liquidity providers. Because it feels like we have enough liquidity. We've been able to absorb quite some pretty large shocks. So I feel like our liquidity is in good shape. So that's staking. As for the actual content of the platform, which I think is the much more exciting part that people are going to be looking at, we are going to be launching with 2 risk factors. The first one is and they're based on the reports that we put in the risk library. So the first one is going to be value at risk. So it'll be value at risk for protocols. So essentially, how much of the TVL of a protocol is at risk during certain market events. The market event can be an exploit that causes downward speculation that market event can be a bad day like we're having today on the markets. And just looking at that and saying what's our kind of like 1% worst case scenario for the platform. And the second factor that we'll be doing is called the liquidity coverage ratio. And what that measures is a protocol's ability to absorb those shocks. So we talk a lot about liquidity when it comes to I've got wrapped tokens that are wrapped by Aave or Compound or even the more complex ones. Can I always convert that base back to the base currency? The answer is not always, and especially if you're holding large positions, you can't always convert it back to the base currency. So those effects are exacerbated by this value at risk metric. And so what we're doing is we're bubbling all of that information down to a really simple just percentage of, in this 1% worst case scenario, how much liquidity gets locked in those protocols. How much can they essentially pay back to the users of the protocols without before they go bankrupt, essentially. So what we see in Cream's case is that they exceeded that percentage due to an exploit, and this will give a pretty clear idea, I think, to everybody of which of these lending protocols is the safest at any given moment. And this changes, of course, with what assets these lenders are supporting, how much they have deposited in these assets. Obviously, more liquidity is generally safer, but not necessarily if that liquidity exists as the native token and not as actual.
So actually, on that note, Collier, if you don't mind accepting the invite to speak. So Collier has been working with one of our partners, YieldApp, and the focus of his research has been around the infamous topic of TVL. Collier, do you mind maybe just priming the folks on like why TVL matters, why it's problematic, and what you're doing to maybe make progress towards a better sort of definition for it?
Yeah, sure. So TVL is important for a couple of reasons. One, when you're statistically applying historical events, things like flash loan attacks, operational risks, you're assessing them against that TVL. So if that TVL is incorrectly reported, and you're using, say, a model that includes a percentage of the TVL that would be at risk in, say, a flash loan attack, then you're gonna grossly overestimate the impact that attack could have. There's also scenarios where you could really underestimate the impact of an attack. So basically, with that starting point, we're starting to build a base around what TVL actually means. So sort of from what I've seen, the best way to apply TVL, at least to like a lending protocol, is only look at the deposits. If you're also counting the loans that are coming out of the platform, then some of those assets are being rehypothecated, and you're going to get an inaccurate picture there. So in the coming days, we're gonna put some stuff up in the risk library about how we're applying TVL to lending protocols, and from there we're gonna branch out and start to expand the definition to what an accurate TVL would be for things like DEXs and the other sort of Lego blocks of the DeFi ecosystem. Moment, how was that on TVL?
Yeah, that was great. I'm curious about the different I know you showed me a cool chart yesterday that sort of lays out all the different factors that go into TVL. I think people maybe oversimplify in their head what that means. It's just like, oh, all the money that's in the protocol. But I think you've shown that it's a combination of like native tokens, like security reserves, incoming deposits, outgoing borrows. Do you want to just maybe just list out those factors that you showed me yesterday?
Yeah, so I mean, there's a lot of things that could go into TVL. So really, I think the important thing in what you were saying, Moment, is to separate out things like security reserves from the actual assets that are being put into the platform. Because at the end of the day, it's the ratio between those security reserves and how much potential capital is at risk that's gonna um, determine the safety of any given protocol. And so, if you're looking at it all together, you're not going to get a very nuanced picture of a protocol's ability to recover from, say, like a flash loan attack or another, adverse market conditions. You're not going to really get an idea of what their buffer is if you're looking at it all together. So, if you kind of separate out the different categories or elements that go into a protocol, all the value that may be on there are controlled by the project. Only then are you going to be able to, only after assessing each of those factors individually, are you going to be able to really model risk very well.
Cool. Yeah. I mean, that's, the literal genesis point of Credmark was, we initially started trying to calculate credit scores and sort of counterparty risk and realized that the underlying data, i.e. TVL, is like completely bonkers depending on where you look and not at all clean enough to allow for that kind of complicated risk, type of risk. So thanks, Collier, for sort of digging into that. And yeah, you guys can expect some more on that as we keep adding to the risk library. I'd like to invite Emily up to chat briefly about sort of the back end of where we're at as far as the data platform goes and just the platform in general. Emily, you there? I've invited you to speak.
Hello, can y'all hear me?
Oh, I guess you're going to be on Collier's screen. All right, that
Yeah,
works.
I didn't have the right headset on, so I figured it would take me longer to switch my headset than to just jump on Collier's.
Cool. Yeah, if you just want to give us a little snapshot of where we're at. I know there's been a lot of work on first order, second order. Maybe if you want to provide some color on what those terms mean and how it relates to this platform.
Yeah, so we've been doing a lot of things in parallel, trying to get to our end goal a little bit faster, but um, we've created these terms, and first order data is what we're calling the data we're pulling straight from the blockchain using the Ethereum ETL open source tooling. And so we've exported that into an Amazon data lake and converted that into an easily queryable format. So that's kind of the first order data. We're calling it raw. The second order is we're needing to take that data and pair it with contracts so that it makes more sense. So that's the second order we're currently working on with one team. And so we're hoping to get like an internal demo in the next 2 weeks on our first few contracts, and then we'll expand from there. And then based on that second order data, we're going to continue on into third and potentially fourth order. So you can see where we're at right now. We've got plenty of areas to optimize while we're working on this stuff, but I'm obviously excited that we're moving forward.
Cool. Thanks, Emily. Neil, who is now next to me and will be using my mic. So we've mentioned VAR, we've mentioned TVL, we've mentioned first order, second order data. Can you combine all these things and explain how they all work together?
Oh God!
To get to this final product.
Whole platform. All right. So essentially,
and I guess why they all are why it's important that all these components are sort of accurate and communicating with each other appropriately.
Okay. Well, so in order for us to like tell people what we want to tell people, which is how solvent are these various DeFi protocols, and how likely are you to get essentially locked out or rugged or whatever. The inputs to those models need to be rock solid. And we want to stay provable as long as we can before we get to the next step. So the interesting thing about like the types of data that we're collecting are first and second order are what we have described as well, Emily was just talking about them, but first order is straight from the blockchain, totally provable. Second order is blockchain plus ABI, so it's technically provable once you have the ABI.
What's an ABI?
An ABI is the description of what the contract does, right? So the way that this has to work is that we take all the ABIs and apply them to the existing blockchain data as an interpretation layer, but it's a provable interpretation layer. Then we go one more step up, and that's the type of stuff that I was talking about before. Value at risk, VAR, TVL.
TVL seems like the most prime third order type of data,
it's
right?
Because it represents something that people know about, but it is you'll get different answers depending on how you're looking at it. So we want to say, okay, can we prove the interpretation of that? That's a super difficult thing to do, and it takes like sort of off-chain consensus, which is why we've set this up in the way that we've set it up, so that we can all look at this and say, okay, TVL on Aave's front end is all their borrows plus all their deposits. Okay, but that doesn't really give us any risk metrics. So now we're going to consider TVL to be all their reserves or their treasury or their native token. So those are kind of the 5 different chunks of that. And we can only get those if we have proven all of the underlying data. It turns out it takes a while to get all that stuff proven, but we are pretty excited about actually putting out some metrics on that top layer. And then, the next step is, how do we make it actionable with artificial intelligence? And I don't even want to get too deep into that, but that's kind of the next step afterwards.
That's actually a great segue. Nish, do you mind hopping into the speaker role so we can give the folks an update on the hackathon?
Hi, am I audible?
Yes, you're audible.
Yeah. So as Nero mentioned, the AI segment, so we tested out a little bit Uniswap specifically. So in a hackathon, the idea was to apply machine learning and statistics to be able to recommend positions to people and also show a backtest, how much money would they have made. So what this essentially does is it helps you devise a strategy and test it first on historical data as a robustness, like on markets going up, down, and normal conditions. When you want to rebalance, try to identify loopholes. So this is some kind of AI that has been implemented in traditional finance a lot, and when it comes to crypto, I think the potential is huge because not many people have seen the strategies yet. So there are already finances that are using the strategies, but they're not adaptable. If you see, they are fixed in most senses. When I say, for example, Charm Finance, they're fixed the ratio that whenever you create a position, create 60% here, 40% here, and then a range order stuff. So they're quite fixed. But when AI comes into picture, it's creating an adaptable, almost a thinking thing. So we tried something similar in our hackathon. Currently, it's mostly statistics. We're not moving into deep learning, reinforcement learning, but it has been a good response. We received over 400 plus submissions. Some of them have overfit, but some of them have tried new things as well and try to adjust, for the movement of the price, whether it be small, like, tightly coupled things like USDD kind of pool or the other ones. So it's going quite good, I think, but as we mentioned earlier in last call as well, more of education can be used in this segment, and we hope we can provide resources for that.
Yeah, and we'll be publishing a more detailed technical analysis of this hackathon later this week, and then we'll be announcing winners of this hackathon. I hope by Friday. Don't hold me to that. There's a lot going on here, as you can tell, and so there are priorities, and the winner announcement might have to be next week, but hopefully it'll be this Friday. I'd like to now open this up to questions. I know we've talked about a lot. I hope we're getting closer as a project to like being able to convey what we do eloquently. It's a work in progress, but if there are any questions at all, this would be the best time to ask them, since this platform will be going live very soon, and the CMK that you may or may not already hold will be have utility in a way that has not existed before that. So please feel free to ask any questions. I'll mute myself for the next 30 seconds, and let's see if anybody has anything. Just to be clear, the questions can be in the community call discussion channel, the text channel, if that was not clear. So Risk Harbor, Slade, if I'm not mistaken, is an insurance platform to a certain degree. Why not? We can bring you on stage. Let's do it. Oh, I gotta find you and all these people. There you are. Cool. You should have gotten an invite to come speak. How's it going, man? We can't quite hear you yet. Still can't hear you if you're talking right now. Maybe a mic, maybe. Yeah, so I haven't looked too deep into Risk Harbor. I do know it's an insurance platform. I believe, from what I can tell, it protects you against different assets. But it doesn't necessarily provide the protection against like market movements that I think. So, like for instance, we just announced a partnership with Steady State. Oh, Neil, you want to jump in?
Yeah, I'll just talk about the insurance guys just for like a second. So there's a few different types of insurance that seem to be emerging, and I haven't looked as closely into Risk Harbor as some of the other ones. We are working with Steady State, and what they are doing is they're allowing the DeFi protocols themselves to insure themselves against specifically against exploits. And right now, it seems like exploits are the big risk that the platforms themselves are really concerned with. But I think that the sort of retail crypto users and crypto investors and DeFi users are more interested in insuring themselves. So I'm not super clear about what specifically Risk Harbor, what position they're taking on that. But when we look at Bridge Mutual and Nexus Mutual, those are for the retail individual, and then Steady State is for the DeFi protocol themselves, so that if they do end up in these sort of like insolvent situations due to exploits, it doesn't bring down the whole platform. It just hurts like a certain set of potential asset holders or what have you. And I know that Risk Harbor, I looked at them when they first launched, and it was a little difficult to get details, but I haven't followed up on that yet.
The
But
algorithm part is definitely interesting, though. I know there's
and
a
then
lot.
Spectral has some announcements now too in the risk space. So I think that's sort of when we're looking at competitive analysis, Spectral's doing the credit scoring thing that we were doing about 2 years ago, but I think the market's maybe more ready for it at this point. Obviously, because they were able to raise money on the credit scoring side. Yeah.
Yeah,
Sorry, I
the
didn't-
algorithmic part is interesting because I know I've talked to quite a few sort of very intelligent crypto minds about how insurance operates in the crypto space, and the decentralized aspect becomes an issue when, you know, if there's an exploit and someone's taking out a big enough insurance claim, and it is in the best interest of the protocol to not pay out that claim, even though that person might be totally justified and it's a community vote and they vote not to pay out, then that seems like a problem. So the algorithmic part is really interesting, but I don't know if you have any examples of this insurance protocol in action. Has it done any payouts? How has it actually fared under like a stressful market condition? If you have any sort of anecdotes about that. Okay, interesting. So yeah, I mean, you know, I don't want to say too much because I think you're right. They haven't had an exploit yet. Yeah, I mean, I'd be interested to see how this operates under an actual exploit. I think there's a danger of insolvency with insurance platforms too. It's not like they're the insurance platforms of traditional finance that have seemingly unlimited amounts of money. It's all, yeah. I mean, you know, we don't want to be. We had this conversation yesterday with one of our partners, in that we don't want to become a audit firm. We're not trying to analyze code line by line by line by line. Now, there are aspects of code that I think are important that fall under our sort of purview, such as like, you know, how diverse are the oracles that are being consumed to decide price? Are you using an asset that broadcasts its own price? So the Cream hack was a perfect example of Cream being a permissionless platform that allowed an asset on their platform that was broadcasting its own price, and because of that, was easily manipulable by a flash loan attack, and thus led to the whole, you know, exploit that then happened. So there's this like fine line of exploits where it's like, okay, someone wrote shitty code and got hacked. All right, that's not our problem, frankly. Like, that's not something we're going to solve. That's not something we're worried about solving. That's just going to be trial and error, and like the good coders, you know, getting work and the bad ones not getting work. But then there's another level to it of like, okay, the code you wrote is working as it should, but was the logic behind it, like, is that sound? And that is something that you can do that's not auditing, that's more like not financial analysis, but like operational is what Collier has been calling it, operational analysis. And that's something that we're trying to focus on. And I think that might be this cool middle ground between auditing and like straight up financial risk that we can really own as a project. And it seems to be the most desired form of like risk mitigation that we've encountered talking to our partners. So,
but I just want to be clear. I just want to be clear that the insurance protocols are like a critical part of the stack that I think Credmark is in the middle of, because obviously we can say, hey, this has, you know, X% likelihood of becoming insolvent, but then the question is, what do you do about it? You know, there's so much that we can tell the retail investors where it's like, okay, this has this you know, this certain protocol has solvency issues, but it only really matters if we're piping that information out to people who are doing things about it. So we've decided to sort of carve out our niche in the stack, and I think our stack is DeFi. The entire DeFi industry is at the bottom. It's creating data that we consume, and then we send the analysis on to the insurance protocols as like a pretty obvious customer of the data that we'll be creating. And they can, you know, the different insurance protocols are going to do different things with it. But I think that we don't necessarily have the scale to be the actionable part of that stack. We are the informational part of that stack. Yeah, as of now. It's DeFi. Things are always likely to change. But
That's well said. I know another aspect that we're going to be really digging into is like the relationship between all these protocols. So like Neil at the top of the hour was mentioning how Yearn touches everything, right? So I forgot the term that you used, Neil. It was a really good term. It was
it's like financial inheritance.
Yeah, fine. You want to maybe briefly touch? We can wrap up after this, but I think that's a really interesting topic that I want you to touch on just briefly before we wrap this up.
Yeah, sure. So, for example, there's a bunch of different curve LP positions that you can take, and that actually allow for trading between different Aave wrapped stablecoins. So you may or may not be familiar, but there's something called curve Aave, I think, and it's Aave wrapped DAI, Aave wrapped USDC, and Aave wrapped USDT, and all those things are tradable, so that you don't have to essentially deposit your own funds in order to get the best interest rates between those three. If you have something that's automated that's doing that, but the problem is that like Aave itself has its own its own treasury and its own reserves that where you expose the risk of any of those single stablecoins to the other stablecoins at that point, because they are inheriting from each other. And also the price of DAI is somewhat backed by USDC. So if there's a problem with USDC, DAI is inheriting its risks from USDC. Then you take USDC, DAI, and USDT. They all inherit their risks from each other if you're in the curve pool. And then you can actually get yield on top of that. So that's kind of what I mean by inheritance, where it's like, is the sort of catastrophic failure or even just market exposure inherited from its underlying protocols and its underlying assets? And then how do you tie those things together? Because it's not Sushi's fault that it got borrowed, on one of these platforms, but it is the platform's fault for including an asset that essentially exposed all of that sushi to the risk of one of the other assets on the protocol.
Comment on it, vouch for us, and apparently that's how it works in Aave. And then once this reaches a certain level of critical mass, it moves to an AIP, which is an Aave improvement proposal. And if we were a part of this permit list, we could adjust risk parameters on Aave without governance votes in an automated fashion. So they could essentially plug into our platform, ingest any sort of metrics that we're producing, and then adjust their sort of any levers they have accordingly to maintain safe levels of reserves, utilization, what have you, anything like that. So, I've never really initiated I've never attempted to like do anything like this on one of these platforms. So this is a first for me personally, but feel free to check it out. We had someone from Flipside Crypto sort of ask some really good questions about our credibility and our reputation and whatnot. And I think we answered them pretty well. So please go check that link out, provide any feedback you have, and we'll see where that goes. There's a question. How do you see the industry changing with the rise of protocols that let you loop these IB tokens? What is an IB token? Can you provide any context on that? Interest-bearing tokens. Neil, you want to take that?
Yeah, I mean, from our perspective, what that's doing is that's essentially we're building higher up the DeFi Lego stack, where you can take interest-bearing tokens and then get interest on your interest-bearing tokens. And this has been around for, probably 18 months now, but we are seeing more and more people get comfortable with the idea that a wrapped USDC that's wrapped in an interest-bearing way is considered as safe as USDC. And I think if we have a problem with an underlying stablecoin that has wide usage, that'll roll back pretty quickly. And yeah, I think the industry is getting more sophisticated, and it makes these kinds of inheritance, the documentation on the financial inheritance, like even more important to know, how these things affect each other. I don't know about, I guess I don't have like a super clear idea of how the industry is changing other than it's becoming more mainstream. I feel like that's maybe not a super satisfying answer. So yeah, I mean, I don't have any more insight than that.
I mean, I think the inheritance aspect becomes more important, right? As you're creating assets that generate interest, how they're getting interest, they're getting yield from somewhere. It's not just coming out of thin air, right? So you really need to be aware of where it's getting that yield from. Is it sustainable? Is it getting yield from a place that has proper liquidity to absorb a shock of some kind? So I would say all interest is not created equal.
Yeah, and a lot of the interest is generated by essentially reducing your liquidity with those tokens at the top. So you can generate interest by making it harder to get out, and I think a lot of strategies use that as a way to like soften movements on these interest-bearing tokens, but I can't think of like a super explicit example. Yeah.
I mean, Olympus DAO is probably the most prime example, I think, of I mean, they've done a good job of showing a really high interest and also showing why it exists and also showing that it's going to go down and that eventually it will all come tumbling down. I think the transparency they've shown is pretty bold, and I think it's something I respect personally.
Well, they're an interesting case because they're in a race between the value of their treasury and their market cap. So they are that's like the fundamental Olympus DAO thing, but they have been generating new ideas to support that
Yeah.
race.
The bond thing is pretty cool and pretty
Yeah,
innovative.
and they're talking about doing a DEX and all of that other stuff. They
Looks like the same fellow has a question about circular cascading loans. How do you calculate TVL when you can circulate cash back into Yearn when the cash is technically borrowed as well?
Ooh, I love this one. This is a really hard thing to do, and right now we haven't found anyone else who has done it. But essentially, we are considering that as leverage in some direction or another. So it's essentially how many times over levered is the actual cash that they are holding. And the way to measure this, it's basically we have to ask ourselves the questions of are the deposited funds generated from the funds that were given out by the protocol in the first place, and then the market cap of the wrapped funds has to be subtracted from the market cap of the circulating funds in order to figure out how much leverage there is. But it's
I
a
think
super complicated question.
this requires a graphic, I think, at some point.
Do you have a graphic? I don't have one of that.
I don't. I think it's something we should make though, because this is
Okay.
a huge,
Yeah.
this happens in compound. This happens with. I mean, there's a very famous case of getting ridiculous yield on stable coins using Abracadabra, and I think Anchor. I think it's through the Terra ecosystem. There's a really cool tweet thread about how to get like 160% yield off of stable coins.
Yeah. So it's like is the lamp plugged into itself, because you have to look at what's coming in and out through the exit doors in order to figure out how much cash is actually inside and how much of it is I create I lend USDC and then I borrow USDC and then I lend that and then I borrow more and then I lend that and then I borrow more. that's the classic example of just like over levering your position because you want to get those yields, and sometimes those yields on the supply side are higher than the borrow side, so you can exaggerate them, and that's yield farming. But how much of that is a circular, like self-contained economy, and how much of that is actually interacting with the external world? And as you zoom out, like you see more and more of this stuff is self-circulating. So, but measuring it is complicated, and again, not a super satisfying answer. But leverage, I think the first step to get a clearer answer on that is to say, rather than TVL, let's look at um, deposits versus reserves versus treasury, and figure out a relationship there that makes sense enough for us to say this is the solvency of the platform itself. And then you can bubble that up composably to all of the platforms that are consuming that solvency risk, essentially.
Well said, Neil. Look, we could talk to you guys all day, but we got shit to build, so I'm gonna wrap it up here.
Such a way with things, Mo.
We'll be handing out POAPs for all the attendees. This was the best community call we've had ever, so thank you guys for attending. We're getting really close to providing some real utility and real value to our community through this platform. Currently, the ARC is probably the biggest thing we need help from our community with. So please, I'm going to be sharing that pretty regularly now in the various chats. Please check it out. Give it a like. Give it a comment. It's a big popularity contest. I don't know why they made it that way, but it is what it is. But I think we are completely qualified to be on this permit list. And if we were to be able to achieve that, it would be a tremendous boost to our project, to everyone who participates in our project. It cannot be calculated how positive that response would be. So please check it out. Give it a link, give it a like. Yeah, we will be releasing a lot of content on the platform in the coming weeks. Like I said, we'll have a hackathon recap soon. So just we'll be in this Discord, so talk to us, raise questions, raise concerns, and yeah, keep on keeping on. Until next time, y'all, take it easy.